Hello everyone, thanks for joining us today. Our WorldStar strategy had a good 2024. Our call today will be led by Jerome Stern and our CIO, Chris Rosbach. After the presentation, we'll move to Q&A. We already have some good questions, and please do send more at any time during the call. I'll now hand over to Jerome.
Thank you, Sandy. A warm welcome also from me to our first 2025 WorldStars Global Equity webinar. We look forward to the great update today. A bit of background first. We are an investment partnership managing a small number of investment strategies based on our own fundamental research with a core focus on quality and a long-term perspective. We manage $2 billion of AUM on behalf of institutions, endowments, wealth managers, and families, with 20% of our assets owned by my family and the partners. This provides investors with a powerful alignment of interest. Our flagship investment strategy, WorldStars Global Equity, represents $1.6 billion of AUM, of which $380 million are in a Luxembourg UCITS fund and another $380 million in a Delaware LP fund, specifically for eligible US investors. WorldStars invests in a concentrated portfolio of high-quality global companies for the long term. Our conviction-led approach leads to a high active share, low turnover portfolio, which has delivered 11.2% per annum net of fees in US dollars for the past 10 years. This performance is built on the quality of our investment proposition, the stability of our investment team, and the repeatability of our institutional investment process. What makes me particularly proud is the quality, experience, longevity, diversity, and stability of our investment team managing the WorldStars Global Equity strategy. The senior team of 4 have worked together for more than 10 years, and all 4 are partners of the firm, thereby strengthening the alignment with our clients. Moving on, how we define quality. Remember, quality is the defining condition for us to invest in a company. We define quality as strong and sustainable competitive position, good and growing industry, management track record, the great value of track record of value creation, and the financial strength to weather any type of adversity. If a company does not display those qualities, it can be as cheap as it wants. We won't invest. We look at these hard qualitative and quantitative criteria in a disciplined manner, making this the cornerstone of our investment process. Our WorldStars Global Equity strategy looks back today on more than 12 years since its inception. During that time frame, we have shown time and time again that we create value through taking a long-term horizon when other market participants follow shorter-term objectives. As you can see in this chart, over the last 10 years, our WorldStars strategy has outperformed the MSCI World Index in 71% of all the 5-year rolling periods. This excellent batting average demonstrates consistency and the reliability and repeatability of our investment process. At that stage, I'd like to hand over to Chris.
Thank you very much, Jerome, and welcome also from me to everybody. We want to provide an update on the performance of the WorldStars Global Equity strategy for last year, talk about some of the attributes of the performance to give you a sense of what has been going on, and then talk about some of the stocks, some of the new the trading that we've done, some of the new additions, and of course our outlook. And I do hope that we will have time at the end for Q&A to cover some of those areas. But I think I have to start with acknowledging that it's a historical moment. We've just witnessed the inauguration of Donald Trump yesterday, and I think among the many interesting things to note as we contemplate what the next 4 years will bring, and in particular, what is going to happen in terms of US global policy, global economic policy, trade, and so forth, and what the impact is going to be on our investments and on our WorldStars Global Equity strategy, is really notable that if you looked at the dais, you saw the CEOs of the world's largest tech platforms, including a number of companies that we own. You saw Tim Cook, Jeff Bezos, Mark Zuckerberg, and Sundar Pichai all there. You saw a number of other prominent industry heads. But one of the things that I noted as we think about some of the implications is that you also had Bernard Arnault there, the founder and CEO of LVMH, with his daughter Delphine and his son Alexander. And apparently Ivanka Trump wore a Givenchy dress for which she explicitly thanked Bernard Arnault, LVMH, and the Givenchy design team for providing it. So there clearly is a lot going on in terms of what we're going to be seeing, and I think a lot of impact that some of which may be as we expect, but some of it as we may not. And as I think, as we wrote in the monthly commentary with which we started this year, I think it's important just simply to remember that while volatility is a function of markets and we all have to contend with it, not all volatility is negative, and there's always room for positive surprises. I think we've seen some of those already over the last couple of months that have been beneficial, and I think it's entirely probable that we will see a number of those going forward. But I think we'll have a chance to talk about that in terms of the outlook as we move along. Just to focus here on the performance of the WorldStar's global equity strategy over last year, you saw that we had a strong year in absolute terms. It was up 16.8% in dollar terms after full fees, up 18% gross. That was slightly behind the MSCI World. It was actually a period of really two halves to the year, a first half in which we performed strongly in absolute and also in relative terms, up 6% relative, and then a second half in which the strategy lagged in large part for two reasons, and we'll go into both of those. One, the factor risk around effectively the Trump trade, so the market rally of types of businesses, in particular financials, that we don't own because we don't think that they fulfill our quality criteria, and issues that we ourselves have had with some of the consumer stocks that we have in the portfolio that have contributed to that performance. I think what the chart shows is that these kinds of periods of lag are opportunities. They're often opportunities in absolute terms, but they're certainly opportunities in relative terms, because ultimately we believe that it's the quality of our companies and the valuations at which we buy them that determine the long-term returns. And I think one of the interesting things, if you just look at the most near-term numbers on the chart in front of you, the -2% in December, you'll notice we actually outperformed a market that pulled back a bit after the strong performance. And so that, to us, is one of the indications for the resilience of the portfolio, the benefit that its diversification offers. And if you looked at the stocks that were among the top three contributors, it was actually LVMH and Diageo, which, as we'll show you, have been some of the real laggards in terms of the performance this year. So if we move ahead, we just want to show you a couple of analyses to illustrate what's going on and our understanding of that. The first one is this analysis here, which is a dot chart. It's a little bit hard to read, but it's based on a fund research company, and it shows global equity funds classified by their investment style. We are quality growth. It's how we would classify ourselves. It's possibly someplace between GARP and growth. It's the question of the concentration of the holdings. So we've owned a number of the right stocks among the famous Magnificent Seven or Magnificent Eight that are been dominating the market and now account for 25% of the S&P. So we've selected the right ones that have performed strongly. But as you can see here, while we've had a reasonable exposure to them, we've actually managed to outperform almost all of the GARP funds, at least on this chart, and a great many of the growth funds. So for us, it's an indication that we are rightly positioned and that we've recognized the opportunities with a substantial exposure to the right of these very large companies that have driven the market because of the growth that they've been able to deliver and the value that they've created. If we then move forward, this is a chart that we've showed you that talks about the factor attribution to understand what has been happening in the portfolio over the last period since 2020 and in the last year. It tells a very interesting story that some of you will be familiar with from previous conversations that we've had. But what it shows is that effectively since the beginning of 2020, so just before the pandemic, our returns have been driven entirely by the stock selection, which is very important to us. This is an analysis we, as part of our investment process, review on a monthly basis. So it is not something that we look at just ex post to explain things, but it is an active analysis that we do that helps us to understand what is going on in the portfolio. In the big interest rates reset that we had, the great rotation, you can see that our active return in gray declined. You can see that the factor return declined. That's in particular growth over value, but it is also so the sector exposures that we have, and of course it's momentum, where we had companies that did very well. Those declined, but you can see that the stock selection remained positive throughout. It dipped down towards flat, and that was primarily digital advertising, which in the third and fourth quarter of 2022 were a big issue that compounded the sell-off related to the rotation. We looked at that, saw that, re-underwrote it, published an insight that is still on our website, that we thought it was a cyclical, not a secular issue, and we were right. And you can see the first thing that happens when the interest rates cycle hits its turning point is that the factor returns turn and they start to appreciate, and you see from then on it's been entirely about the selection. The reason why it's so interesting to look at it now is because something similar has been happening. And you can see the first thing is that the selection effect has started to decline. That is the issue that we've had with consumer stocks that we've been re-underwriting. But then you can see that since then, it's been very much the factor exposures that we have. That's to some extent the Trump trade and the strong performance of, in particular, financials that have been contributors to the overall market, but it is an area, again, as I said, that we tend to avoid because we think over the long term, while there can be valuation gaps and those gaps can close, and there's clearly very well run balance sheet driven financials, and they play an important role, we think that these are not the types of compounding businesses that we want to invest in for the long term. It's very interesting. You can see, we use it to see that there's something going on in terms of the consumer stocks, which has led us to re-underwrite them to increase our conviction. But you can also see that the fact that the selection has remained flat since then is something that indicates to us that this is something that has to do with markets and short-term moves. And as Jerome said in his introduction, these are the types of things that are opportunities for long-term investors. So if we then briefly turn to the perspective in terms of our weightings compared to the market, we invest on an absolute basis, but it's clearly interesting to look at these to understand where we're taking exposures and what types of opportunities and risks we have in the portfolio. What you can see is for calendar 2024, this is the MSCI World, had clearly a strong year. You can see that it was actually led in part by technology and communication services, areas that we own, but then by financials and by consumer discretionary. If you look at our portfolio, you can see that we're actually equal weight information technology. We're not even, or actually slightly underweight, so we're not even overweight there. Where our overweights are is in communication services, in consumer staples, in industrials, and in healthcare. We're underweight in consumer discretionary. That's, as we'll show you in a moment, includes in particular Costco and Walmart, two great companies that we think are very fully valued. And we're underweight financials as well as utilities and other areas. So that is what we see in terms of the portfolio. And then if we turn to the attribution analysis and we tie it together, then you can see where we've been selecting stocks and where the allocation and the selection effect have impacted what we've been doing. You can see that in information technology, communication services, industrials, as well as in healthcare, we've picked the right stocks. We've had in some cases the right allocation, but in particular, our stock selection has been very strong. What you can also see is that in consumer discretionary, first of all, we don't have quite the same weighting, but we've also have an issue with the stock selection, but in particular, you can see the underweight in financials there. And at the very bottom, and highlighting, I think, very consistently, the issue with consumer staples, where the stocks that we've selected have performed poorly, and where we see a tremendous opportunity today for turning around. So it's an example of the analysis that we have to understand what is going on, to understand where the positive impacts have come from, but also where the negatives are, to hold ourselves to account and to give us the framework that we need in order to be able to direct and push our research and to increase conviction, or decide that we have made a mistake and that there's some kind of more fundamental change to the investment thesis that we need to address. If we then just turn to the overall exposures, just briefly, our focus on quality and the criteria takes us into digital transformation, consumer, healthcare, and industrials. You see in our own classification what the weightings there are. It's about 44% in digital, and it's in particular 23% in industrial, something we think is very important, very differentiating, and where we see tremendous opportunities that have contributed already to the portfolio, but that we think are also going to be significant contributors going forward. You can also see more of a reminder for many of you where the areas that we look to avoid, because we think that capital intensity is often a form of stranded capital that is getting disrupted, balance sheet driven financials where we think the analysis is challenging, and where we question the long-term compounding nature of those businesses, given the need to support them with capital and the regulatory burdens that are on them, and government and regulated businesses, given the issues that we have around, in particular, the constraints on government budgets, taxation, environmental concerns, and so forth. And then I want to shift forward and just look at where we are right now in terms of some of the valuation and the growth that we're expecting, because it explains, again, I think, some of the positioning of the portfolio. Overall, if you look at markets, it strikes us that there is great concentration, and that there are also some of the very largest companies that are also among the fullest valued. We do not think that our companies are among those. We think that we own companies especially among these very large ones, that while they're now at fuller valuations, still are very attractively valued, given their long-term perspectives and their growth rates, both on the fundamental valuation that comes out of our discounted cash flow analysis, as well as just looking at price to earnings ratios as a useful way of looking at these kinds of valuations on a comparable basis and over time. Our own stocks here are in blue, and among the Magnificent Seven in this instance, it's sort of controversial what the eighth one might be. Then you can see that at the higher end of the valuation range, Apple and Microsoft, we think, are really very fully valued. You see that NVIDIA and Amazon, that we think are still very attractive companies, are at similar valuations, but we've just highlighted here some of the growth rates. You can see that both NVIDIA and Amazon have very significantly higher growth that is expected than Apple and Microsoft. And so we think that these are much more attractively valued companies than the other two. You see that Alphabet and Meta in particular are at much lower valuation levels. In the case of Meta, it is never been at a very high valuation on a PE basis, but it's at the higher end of what these ranges are. But we think that you can see the growth rates are roughly comparable, but the valuations are much lower. And so we find that very attractive for these very high quality companies that we think have great prospects. And you see Tesla, which is, while very high growth is expected, it's also trading at very high multiples that we think more than fully discount the growth that is expected, in particular, given the risks to the underlying business. And then we've just highlighted some of the other stocks, and I think in particular for us relevant for healthcare is Eli Lilly, Novo Nordisk, and it's relevant for the consumer discretionary, which is Costco and Walmart. You can see that some of these stocks are, for the most part, also really quite highly valued, we think, or they have risks to their underlying businesses. And because while we like quality companies and we think that Costco and Walmart in particular are extraordinary franchises, we're also very valuation focused. And so for us, these are valuations that are too high, and we prefer to invest in the stocks that we do where we think the quality, the growth prospects, and the valuation offer greater upside. And then shifting again from this perspective on the valuations to the 2024 stocks and the way that they have performed. These are the stock returns, and I think it's interesting to see the top three continue to be in digital transformation, but you see the next ones are all in industrials and infrastructure. So I think the diversity of the portfolio is, I think, very visible here and is instructive, and I think it's equally instructive to look at, and these are our own classifications, at the bottom end where you can see that there's really a cluster around these consumer products companies, just another perspective to highlight what has been going on and where we see the issues. Adobe, for example, had an 80% year in 2023, and we decided to reduce the position by about 100 basis points in December of 2023 because we thought some more of the valuation had been pulled forward, and you can see it did perform poorly last year. We now think it's oversold and very cheap, but it's an example of the proactive trading that we do that takes the quality but also the valuation into account. If we move to the active weightings, this is tying in some of the previous points. You can see our highest active weight actually is Eaton. It's not even NVIDIA, despite the fact that it's a close to 10% position throughout the year. But you can see again, NVIDIA, LVMH, Amphenol, ASML, a very diversified set of companies that constitute the top 5 active weights, and I've highlighted some of the industry weights in the previous discussion. So that really now takes us to where what we have done in terms of the active trading as part of this update, which we did in December of last year. We've decided to reduce some of the positions in the stocks that we've had in digital transformation. We reduced the position in NVIDIA primarily because of portfolio concentration and risk reasons. We have a 10% maximum position size, and NVIDIA hit up against that again, given its strong performance. But we also know that growth is going to slow down from the extraordinary levels that they had as we look forward past this year into the coming years. And so after the very significant growth, we do also think that there clearly is some risk because of the slowing momentum in sales. And so will be sensitivity around that. So we thought it was prudent to reduce that position and to reallocate the capital. We decided to reduce the positions in Alphabet, Amazon, and Meta for valuation reasons. We still have large and core positions in these stocks, but again, not unlike Adobe in December of 2023, we think that the gaps to our fundamental value have narrowed somewhat, and that therefore we think we had more attractive opportunities to reallocate capital to. The same is true for Eaton. You saw it's our largest active weight. We still think it's very well positioned with all the investment that's necessary, but the valuation is now well above at the top end, really, and above its averages. It is also closed some of the gap that we have in our absolute valuation, and so we decided it was an opportunity to reduce it. And what we've done with the capital is 2 things. One, we've added a new holding in Intercontinental Exchange, ICE, which I'm going to talk about, and we reinforced further the positions in Diageo and Honeywell, the consumer and the industrial companies, because we think that they are both very attractively positioned and valued. Diageo at really a low point of its cyclical impact. I'll talk about it in a second, and at a low valuation, and Honeywell in the midst of active portfolio review with, we think, a lot of upside to the business and again to the valuation going forward. I just want to highlight then on the consumer stocks, given the impact that they've had this year and given the fact that we think that looking forward, these will be one of the sources of performance that we have. We think it's not dissimilar to the sell-off in tech stocks in 2021-22 in terms of how cheap these stocks are. Again, we've given it to you here compared to the 5 and 10-year average price to earnings ratios because it's an easy comparison. What you can see is that these very extraordinarily strong franchises are trading at significant discounts to those ranges. They're also on significant discounts on our absolute value DCF valuations. So we think it is an extraordinarily compelling entry point. We have been buying these stocks since the fourth quarter of 2023. So we have acted too early. That is what happens to us. We also bought NVIDIA too early in February and March of 2022 and then bought more in November. We've been reinforcing these positions because we have the convictions that we're going to get to these turning points. In the first quarter of last year, Diageo and Pernod were among the strongest performers when there was a perception in the market that the consumer and inventory issues they're facing are turning. And as I said, the same was true for LVMH and Diageo in December of this year. So we don't, excuse me, of last year. So we don't think that there's an indication that there's some kind of market issue that they've got. And we think the secular concerns around alcohol and so forth are really overdone. And these are cyclical opportunities because of the issues that they're facing. We've put Walt Disney here as well. We've talked a lot about it. Moana 2, I thought was a great movie. My family agreed. The stock was up 24% during the year. So it's done pretty well. We still think it's very cheap given the parks and given the other entertainment franchises that they've got. So now I just want to touch a bit on some of the stocks that are large positions and just make a few comments on it. The first one is around NVIDIA, which continues to be our largest position. It's always clearly a question of where the company can go from here in terms of its business, in terms of its valuation, given the performance and given the very significant market cap that it has. We continue to think that it's very well positioned. It has a powerful competitive position. We think we're in the early stages of AI adoption. We have a lot of the use cases in effectively the white collar settings around efficiency, around data analysis and so forth. But as Jensen Huang has highlighted during the year, there are also tremendous opportunities in blue collar settings, industrial robotics, automation areas that we understand very well and that we have exposure to through our industrial companies. So we think that we're really very much at the beginning of where these opportunities are. With significant scale. We're also still at a very attractive cycle in terms of where we are in terms of the GPUs. We don't see competition coming in. We see the supply chain working. We see the very significant data centers that are being built to satisfy the demand for processing capabilities. The UK just published its AI strategy written by somebody we know, in which they're talking about a 100,000 GPU data center. Well, that's the Colossus that Meta has already built. The next large Meta data center is going to be 300,000 GPUs. So there is a very significant demand for the processing capability that comes from NVIDIA's GPUs. And so we think there's tremendous opportunities there. The last time around, the tariffs actually worked in NVIDIA's favor because Chinese consumers were only able to buy less capable processors and therefore had to buy more of them. We will see what happens this year in terms of these tariffs. But I think as we've seen, there are a lot of moving parts to that. We reduced the position again because of portfolio concentration issues and because we think that there is some element of a slowdown that is going to come, but it is still our largest position. So for us, it was a question of the opportunities that we see and wanting to take advantage of those. We then move to EssilorLuxottica, the global leader in eyewear. It's one of our top performers in healthcare and consumer companies. It's still an extraordinary company, the #1 in sunglasses, number one in lenses. If you now go to airports, you see Ray-Ban, Oakley stores everywhere. So they very much have controlled the distribution. They also control the lenses that are produced from the Essilor side of the business. So the vertical integration, which was part of the point of the merger, has led to significant benefits of scale, but also of innovation and of cost. So we think it continues to be very well positioned. And for us, one of the interesting things is to see that the demand for eye care and for sunglasses clearly is exceptionally strong. They're benefiting from the travel that is taking place. And we think the fact that there is such demand for their products is a positive indication for the demand for luxury products and other consumer discretionary products as we move along and as consumer spending stays resilient, the gap closes in incomes and people feel more confident. There are great consumer franchises at scale, $115 billion market cap, that are prospering in this environment. And so it's one of the areas where we see read across. They see blank spaces from the acquisition of Supreme, which they did last year. It was negatively received by the market. We talked about it. We think there is a completely blank space in terms of an urban streetwear sunglass brand. And our prediction is in 3 to 5 years, we're going to see Supreme sunglasses in the same way that we see Ray-Bans and Oakleys for different type of consumer preferences. And briefly on Diageo, one of the challenging stocks, but we think also one of the great opportunities. We've put in these charts where we bought them, so you can see we bought that first in June 2016, and in aggregate it had done very well. It's now clearly had a significant pullback because of these concerns. We think that they're cyclical, not secular, has to do with the pandemic, has to do with the fact that supplies completely ran out during the pandemic, the fact that then there was overstocking as supplies in the distribution chain were increased again, has to do then with the rising rates, which make that inventory much more expensive for the distribution, then the sell down. And we think that we're at a moment where we're at a cyclical low in terms of the sell in that Diageo has into its network, the sell out, the inventory levels. And so we think that there's positive growth to come. We've already had, you can see numbers that were slowdowns, but by no means catastrophic. And there's operating leverage to come. So we think that it's now at a very attractive moment. It generates a lot of cash. It's at a low point in its absolute and relative valuations. It has a very attractive free cash flow yield. It has a strong dividend yield as well to support it. And as you could see, it's one of the reasons why we outperformed on the downside in December of last year. So we think it's exceptionally well positioned after this very difficult time, and think that our conviction here will be rewarded. But clearly, as the year progresses, we will continue to monitor and we will continue to update on them. And then moving to the new position, Intercontinental Exchange, ICE. It's a leading global exchange. It fulfills all 4 of our quality criteria. We've been monitoring it on our watch list and then on our approved list for a while until we finished our analysis, and we thought that there was a valuation opportunity because of a pullback and because the company has earned itself into its valuation. Despite the strong share price performance that it has. It's an unrivaled technology platform. It owns the New York Stock Exchange, strong competitive position in that. It straddles finance and tech. 55% of the revenues are recurring. It is the leader in energy trading. 80% of oil is traded, of the Brent contract is traded on ICE, also natural gas, also carbon. So there's significant structural demand, as there's demand in aggregate, as there's demand for the processing capability that's necessary for II, and as there's also then a need not just for the demand, but also for the hedging. We think there's significant structural growth there. They also have growth businesses in fixed income trading and in mortgages that are still at much earlier stages of being rationalized. They think they can take the lifetime processing cost of mortgages from $10,000 down by $3,000 to $7,000 with their technology. And so we think that that's very attractive. They have 70% margins with high cash generation. They have a track record of being able to reinvest that cash flow in internal development and in acquisitions. And so we think it's at a very attractive valuation entry point for this leading exchange and data service business. And so that's why we decided to buy a 3% position in December. So that's the update on some of the stocks that we've got. In terms of the outlook, I think what we think is that the basic perspective that we've had has been right. You have had a resilient overall economic growth, in particular in the US, but also in other large economies. You've had resilient underlying consumer spending, a resilient employment. You've had wage increases. You've had a slowdown in inflation. You've had a normalization in interest rates that are now at 4.6%, so at the higher end of normal. When I first started my career in investment banking at Lazard Frères in '94, 4.5% was the risk-free rate, and we're right back. So very clearly a normalization that has taken place that I think is in line with what we've been expecting. You've had some of the shifts that come with that, some of the valuation gaps that have closed, in particular within banks, we think, and so that's why we're really quite constructive. Europe is clearly struggling in different ways with some of the structural issues that it has. There's also some more elections coming, in particular in Germany, but some of the underlying dynamics we think are in place, and China is clearly struggling as well, although the government has been putting increasing measures in place, and at some point we do expect a bottoming. That's an area where we have been more optimistic, and where clearly it has taken longer, but it is something that we're watching very closely. So against this backdrop, we think we're really quite constructive in terms of the outlook. Again, some of the stocks and markets are really very fully valued or overvalued. We don't think ours are. So it's going to be much more about companies than about markets going forward. We think it should be a market in which stock pickers can perform and outperform because these quality differences and because these valuation differences are likely to make a big difference. From our perspective, we think that if things turn out to be okay, the caricature that we like to use as our basic outlook, then we think we should have the prospects for strong performance from the growth in revenues, in earnings, and in cash flows that our companies have, and from the valuation upside that they have. And if we have setbacks, as surely we will, or if there are greater dislocations, in particular from perhaps some of the initiatives that the Trump administration are going to take, or some short-term reactions to some of the announcements we may see on tariffs and other things, we think the portfolio will be resilient because it does not have the momentum risk of the broader markets, and in aggregate, it has much lower valuations. And again, we see indications from our risk analytics that that's going to be the case. So that makes us really quite constructive in terms of the outlook and the portfolio that we have and the companies that we own. So very briefly, just to close, this is a slide that we like to show. We think that quality is worth the price, and you can see the portfolio has much higher revenue growth, has higher growth in EPS. This is just looking into 2025, much higher margins, reflecting the quality of the businesses. And while it is trading at a somewhat higher price to earnings ratio on a weighted average basis, we think that quality is very much worth the price that we're paying.